Performance management tools are different from strategic management tools. Strategic management tools are more of planning tools, where performance are assessing what are tools for assessment of what has been carried out or implemented. So we'll be speaking to the first one, which is critical success factors. Is a performance management tool, critical success factor. We're looking at areas and vital areas that must go right for strategic objectives to be achieved. So critical success factors are very important for a business because they help you to harness and also assess what needs to be done for your business to really thrive and also make those impacts that were intended to be made from inception. So critical success factors identify key areas of activities that must be successfully managed for an organization to achieve its objectives. This is very, very important. So components of strategy where the organization must excel to outperform competitors are what need to be critically assessed. So key factors for business success, achievement of critical success factors help cope with changes in a dynamic and competitive environment. So limited number of areas ensuring successful competitive performance must be looked at. So the critical success factors requires us to look at core competencies, difficult for companies to copy. Those areas of advantage, those niche you have, the things you do or produce that no one else could except you. They are found in your production, your skills, your functions, your techniques and technology. They vary by business and industry players. So it's very important that critical success factors are assessed, and they are essential elements or areas that contribute significantly to the success of an organization or a product. So the key is defining factors central to the organization's future success. So there are 4 types of critical success factors. So take note of the main components like the types and the main components aside the definition. The components or the types are how we are being able to apply it in the case scenario under exam condition. So what are the types of critical success factors? We have the industry CSF or the industry critical success factor resulting from specific industry characteristics. So for example, in the banking industry, we have some kind of banks that are doing well and some are seemingly not doing well. So industry critical success kind of factors look at the characteristic of an industry, such as maybe the tech industry, innovation in the tech industry, or low-cost leadership in a retail industry. So the industry is a type of critical success factors, and the industry where that business is domiciled also determine how it will be successful. It's very important. Also, the strategic critical success factors. This results from choosing competitive strategy and market position. This is very important. So the strategy at the top, the planning and the strategizing, like we use those critical words, are very important. Strategies are directly tied to the organization's goals or objectives, such as maybe market penetration, product differentiation, product enhancement, market development, market scheming, cost efficiency. So those are strategic critical success factors, and they are very important. And the next type of critical success factor is environmental. It results from the economy or the economic changes and technological changes which are external to a business. Very important. So environmental factors like regulatory compliance, payment of taxes, and some other environmental factors, customer demand, or economic trends that impact the business are very important, also critical success factors for a business. We also have temporal critical success factors. They result from short-term internal organization needs or internal organizational crisis. So temporal speaks to time-bound factors that are critical or crucial at certain stages of a project or a product development or a life cycle, such as meeting deadlines for product launch. They are temporal critical success factors. These are very important. And also, there is one more. I don't think it's on this slide. One more speaks to managerial critical success factors. So internal processes like leadership effectiveness, employee skills, or quality management that drives overall success. They are also critical success factors. So we have, okay, 4 of them, but I think there are 5. But then if you have 4, it's okay. So industry, strategy, which is also managerial anyway, because your formulation of strategy comes at managerial level, and environmental and temporal. So you could make it 4 or 5 if you want to differentiate strategy from managerial. Yeah, you're trying to say something. Yes.
Oh, no.
Okay.
I was just confirming. Yeah.
Okay. So you could merge strategic and managerial, or you could put it separate, but they seemingly are the same. So managerial speaks to internal processes of leadership, effectiveness, employee skills, quality management, and that helps you directly to drive the organization's goals very, very strategically. So it's important we take note of that as critical success factors. So how do we develop critical success factors? It requires understanding the business environment, internal and external. We understand the industry, the firm the firm that we have, or our business. Then we should also understand our competitors. That's how we develop our critical success factors. So we understand the internal and the external environment, the macro, which is wider, macroeconomic environment, and the micro, which is our internal economic environment. We understand the industry we are resident in, our company, which is our firm, and our competitors. That's how we develop our critical success factors. So they are observable and measurable factors. They are also high impact factors. So critical success factors are activity statements starting with action verbs. So when you see a company's mission or vision statements, they are driven through critical success factors. And we have critical success factors comparing them to key performance indicators. So critical success factors are different from key performance indicators in that critical success factors are vital for strategy success, while key performance indicators measure objectives and strategic performance. So the difference between both is that one is vital and it's at the planning stage, so to be, while KPIs are looking at the result of what you've done. So critical success factors are more of planning models, while key performance indicators are performance, what you've done as a result of what you've planned. So they measure objectives and strategic performance. So examples of critical success factors areas are training, data reporting, management's commitment, customer satisfaction, staff orientation, quality control, communication, continuous improvement. These are critical success factors areas that we need to be conversant with. So they are very, very good because they help an organization stay focused. If success is the goal, then you need to critically assess what it takes to succeed as a business. All right, so that will be the end of critical success factors. Do we have any question? I believe this is very comprehensive and succinct. Any question?
None from me. I think this critical success factor is really just tailored for banks. I don't know.
No. It's tailored for all organizations. So you could say in the banking industry,
It's more
you
useful.
could access is more useful, yes. But for other businesses, healthcare, FMCG, pharmaceutical, high tech, any area of business or industry is relevant. It just depends on the application. And I don't think he has tested this model in any question. So this performance model could be tested is really examinable. So take note of especially um, the the four types, which is industry, like we said, strategy, environment, temporal, and maybe managerial. So 4 or 5. Take note of those 5. So if you understand these types, you can apply them under exam condition. Just understand those key phrases or those key components. And when you hear critical success factors or apply critical success factors based on this, that in the exam, it will resonate with you and you'll be able to speak to it. Okay, so let's go to the second model as we are running. We're looking at key performance indicators like we just compared it to CSF. KPIs are metrics that measure the value produced by a business, a program, or a team, or an individual. It measures the achievement of your critical success factors. Exactly. It can be financial and it can be non-financial.
Non-financial.
Exactly. So KPIs are more comprehensive because we use them almost every time in the office. They say, what's your KPI? What's your KPI? So we have good KPIs because the measure of a good KPI speaks to the objective. It shows performance and change over time. It focuses on employee attention, measures accomplishments, and provides common language and reduces uncertainty. So good KPIs have these components. It's objective, it shows performance and change over time. It focuses on employee attention. And that is why when we are doing performance appraisal, they ask what are your KPIs? And they measure your performance based on those KPIs. It helps measure accomplishment and what is being done. And it provides common language between staffs to see those that are performing and those that are not performing. So what are examples of KPIs? We have return on capital employed. Return on capital employed is what you've gotten as profit from what input was made in that activity. So revenue per employee, what is the revenue generated by the number of employees in that establishment? Customer satisfaction, are customers satisfied with your goods and services? Return on investment, what returns are you getting from the purchase of long-term and short-term investments? What are your new revenue rates? How productive are you? How efficient is the company? Are there wastes? So these are examples of KPIs to measure. TATs, like in the healthcare sector, TAT is very important. How long do you come to my office to do blood test or full blood count test? If we say 2 hours, do we meet those turnaround time and give you a result in 2 hours? So these are KPIs for measurement. The volume of what you produce, your quality, your budgeted and your variance. How do you measure your budgeted and actual, the difference, the variance? Budget variance, schedule variance, defect density. These are all examples of key performance indicators, and they help you to understand where you are as a business. Yes, please go ahead. Go ahead.
No. I'm not interjecting.
Oh, okay. That you're speaking. So KPIs are good, and I don't think he has tested it, maybe because it's very simple. But then, if he asks you for KPIs application in any case study exams, you'll be able to understand the examples and how to apply them, and also good KPIs and how to provide them under exam conditions. So if he gives you a case and says use a KPI performance model to speak to that. So we must understand that KPIs must be smart, and the smart KPIs are we're speaking to being specific. A KPI must be clearly defined and targeted to a particular area of performance. It must be measurable. That means you must have data to measure it. It can be collected and analyzed to assess progress. The A is it must be achievable. That is realistic goals that an organization can attain. It must be relevant. It must align with the organization's overall objectives or aim or strategy. And it must be time bound. So KPIs should be able to be tracked over a defined period. So like daily KPIs, monthly KPIs, quarterly, half yearly, annual KPIs. So it's the characteristic of an effective KPI is that is measurable, is smart. Don't forget those key words, smart.
Yeah, smart.
Yeah. So types of KPIs, like we said, there are financial KPIs. Looked at them here based on the examples. So this could be the types. Financial KPIs in form of return on investment, return on capital employed. Those are financial investment.
KPIs. Okay.
Yes, financial KPIs, I beg your pardon. They measure financial performance like your revenue growth, profit margin, and return on investment. So those are financial KPIs. Then we have operational KPIs, which are also what we have here as examples, and they could involve maybe production capacity, efficiency, cost per unit, lead time, turnaround time, like we spoke to. Those are operational KPIs. You are tracking the efficiency of your internal processes. Very important. Then we have customer KPI, which are also types. Like we saw here, we said customer satisfaction, how you are able to ensure return of customers to patronize you, customer satisfaction and engagement. Exactly.
When they're satisfied and should I say the value of what you're giving out, they will always return.
They will definitely come back. So those are customer KPIs. Then we have employee KPIs, staff satisfaction. You measure your workforce performance and development. Look at employee turnover. Why are people resigning? Employee satisfaction, your training completion rate, and all that. We also have growth KPIs. You could categorize them as that. Growth KPIs they track organizations' growth by market share, number of customers you have, product launch success rates. So these are growth KPIs. And you develop KPIs by having a clear objective. You have clear business goals to increase your sales maybe monthly by 10%. And you have areas to determine to determine key areas in the business: sales, marketing, customer services, and you set targets for them. You monitor them and analyze what they are doing. You adjust as needed, and the benefits are actually it provides clear focus for a business. It enhances decision making by offering data-driven insights. So KPIs are very beneficial. It helps you track progress towards strategic goals. It improves profitability and really helps you drive success. So KPIs are very good. It has not been tested. If it's been tested, please give it your best shot. Okay, so you spoke to that, and I loved your engagement on the KPI discussion conversation. So number 3, we look at value for money audit. Value for money audit.
Is this a model also? Value for money audit.
Yes, it's a performance model. I used to remember it in public sector in school. It's almost the same thing in public sector. Value for money audit. That's why I call it value for money audit. But under performance management model, it's called value for money. So it's measuring the performance mostly for NGOs within financial constraints where they have financial issues. This model helps you to aim for the best with the available finances you have. So businesses could apply this model where they have limited financial issues or financial resources and aim to get the best value. Mostly, like you see on the screen, is applicable to the public sector. And I remember it vividly in public sector accounting when I was writing public sector in school and also in the ICAN. So this helps us to measure effectiveness, efficiency. And I think the 3 E's, there are 3 E's I can't forget: efficiency, effectiveness, and economy of a product
An
from the
economy,
customer's
yes.
perspective. Yeah, you could remember it. You remembered it, right?
Yes, sir.
Uh-huh.
The
I
three
too
E's.
remember it. The 3 E's, yes, from the customer perspective. So the
Yes.
elements, oh, okay. The elements is even on the slide. So we have
Oh, okay.
economy. We have economy talking about spending within limits. You're avoiding waste, achieving same results with lesser cost. And that's what economy speaks to. Then efficiency is getting more output from available resources. You are being more productive, avoid waste. That is what efficiency speaks to. There's no effectiveness, but effectiveness speaks to having the achievement of your objectives, and they come to pass because you ensure that you are effective in that area of business. So you achieve desired outcomes or impact. So effectiveness measures how well the output contributes to your organizational goal. So that's not on the slide. We only have the efficiency and the economy, but then effectiveness speaks to how much you are, as a business, achieving your desired outcomes or impact. It measures how well the output contributes to goals. So generally, value for money speaks to efficiency, effectiveness, and economic use of resources, maximizing the benefits gained from every unit of expenditure. So it's defined as a performance management concept that assesses whether an organization's resources are being used wisely to achieve the best possible outcomes. So often broken down into the 3 E's we spoke about: economy, efficiency, and effectiveness. So to ensure value for money, we need to plan and budget. Exactly. You need to monitor your spending, review outputs and outcomes, and identify opportunities for savings. So value for money is beneficial because it helps us to make informed decisions on resource allocation. It increases accountability for public funds, especially in the public space, business space, common with governments and NGOs. It enhances or ensures a balanced focus on cost, performance, and quality. It also drives continuous improvement by assessing what works well and what doesn't, and where can we improve. So that's what value for money speaks to. It's very comprehensive, and if you test this one, I know you'll be able to apply it practically. I'm very sure, right?
Yeah, it's actually comprehensive.
Yeah,
And quite
excellent.
interesting too.
Yes, it's quite interesting. I love it because I apply it also in my personal life. It helps me be economical, effective, and efficient. Okay, so the second to the last is balanced scorecard model. He has tested this. A very practical and nice model, which we also use in my office. As a matter of fact, our current model for reporting quarterly is the balanced scorecard model. So it's a strategic planning and performance management tools that communicates objectives. It aligns work with strategy, prioritizes projects, and measures progress. So it looks at the organization from 4 perspectives. And those 4 perspectives are very, very practical. So the essence of the balanced scorecard model is to provide a comprehensive framework for translating an organization's strategic goals into measurable performance metrics across multiple perspectives. And these perspectives are 4. So a performance management tool that aligns with the business's activities and operations with the organization's vision and strategy by focusing on the 4 perspectives we'll be talking about. So number 1, we're looking at the 4th perspective that links performance in addressing customers, your internal processes, your innovation and learning, and financial.
Financial.
So very important, yes. You're looking at critical areas of number one, your customers, your clients, and your business processes. Very important. How you innovate and learn. That is, you build your workforce, human resources, and also your financial capacity and your financials. So those four areas are very cardinal to the success of a business. Very critical areas. So number one, you're in business for clients, customers. Number two, the processes that lead to your products. And number three, innovation and learning. You are growing by teaching, growth perspective and financial perspective. This is very important. So the balance scorecard is very practical. And like I testified, I said we use it currently in my office. So it was developed by Kaplan and Norton. Very good, nice, bright minds. They develop it to measure performance against long-term objectives. So they balance financial and non-financial. So you see some models look at mainly money, but no, they started with customer and they looked at number two, your processes. Number three, your human resources, innovation and learning before financial. So financial is even the last. And it's a good model that balances an organization. And that's why it's called a balance scorecard. It balances financial and non-financial goals to achieve that synergy. So the aim for satisfactory balance between targets for each perspective is very important. So it is futuristic in its approach. That means it encourages a long-term view and can incorporate short-term targets also, aligned with budgeting and incentive schemes. So what are these four perspectives? Let's look at them one by one in detail. Customers. What do customers value? Is it cost? Is it quality or delivery? And that's how you harness your customer perspective of it. So you ask yourself, yes, what is the cost of the product or the service to them? What is the quality that it brings or it adds to them? And how do you deliver it? Is it fast? Somebody comes for a test now. You tell him 2 hours and the person stays 5 hours, 6 hours. You're not delivering very, very expeditiously. So what do customers value? Identify it and give it to them. Very important. And the next one is internal processes. What must we excel as? Our key operational processes. Are they too cumbersome? Are they too long? When somebody comes into your office, he wants to access a service. How long does he stay there to access it and go? So our internal processes should be very easy. Your internal controls, of course, you want to install internal controls to avoid waste and fraud, but then let it not be at the detriment of your customers. So operational processes should be seamless and very easy. Innovation and learning. Can we continue to improve, create value? So training and retraining, improving skills, making your staff knowledgeable and introducing new products and technology. And that's what this third perspective speaks to. And finally, financials. How do we look to shareholders? Our share price, how profitable are we, our return on investments, long-term and short-term. So for each perspective, we need to identify key performance measures based on the business or the industry we are domiciled in and measure those targets based on our performance. So the focus on strategic objectives and critical success factors for future success is what the balance scorecard reports to. It's a main performance report and is very, very practical. I love the model, and my current senior management team, like the CEO here, loves this model very much. The examples of measurement listed for each of the four perspectives: the financial, customer, internal processes, and innovation and learning. It's a holistic view. They interdepend on each other, and the perspective coordinates metric-driven incentives, and they help us to really harness and help the business to thrive. So it's very important that we know these perspectives are implementable. So if you have a clear vision and strategy, you can implement the balance scorecard. So align the scorecard, yes, with the company's long-term goals and strategic vision. So develop objectives for each perspective. So create specific objectives to link your customer, internal processes, innovation, learning, and growth perspective, and your financials. Then set measurable KPIs, exactly. Set measurable KPIs for each perspective. Establish quantifiable KPIs to track progress towards the objectives. Then you align initiatives, link ongoing projects and initiatives with the objectives in each perspective to ensure fruition and strategic alignment. Monitor and review progress monthly, quarterly, half yearly, because the benefits are very immense. The benefits of the balance, applying this balanced scorecard model is it provides a balanced view of performance beyond just financial measures. They incorporate non-financials also. So they align to day-to-day operations with long-term strategy. And it also encourages cross-functional collaboration by integrating financial, operational, and customer-focused groups. So in summary, it helps us to improve decision-making with a structured approach to performance tracking. This is very, very important. Okay, so it's a sweet model and I love it. I don't know if we have any questions on the balanced scorecard model. He has tested it either once or twice. Yes, but it's a potential area he may likely test. So let's understand those 4 areas. So number 1, customer.
Yeah.
Number 2, internal processes. Number 3, innovation and learning. And number 4, financial. So if you understand those 4 components, you can apply them graphically under exam condition. All right, so any question on the balanced scorecard model?
No.
Okay, fantastic. We comprehensively understood everything. Okay, so finally, economic value added. This is the final model or final performance model. We have economic value model. It measures economic profit after deducting the cost of capital employed. So this model looks at your economic profit from the macroeconomic perspective. What value has the economy added to the business based on profit generated after you've removed the cost employed? So it addresses weaknesses of profit as a sole measure of business value increase and looking at capital cost and accounting conventions. So generally, the economic value added model is trying to address the issue of the financial performance of a company by assessing whether it creates value beyond the required return on its invested capital. So it indicates how effectively the company capital is being utilized to generate profit. So that's generally what the economic value added model speaks to. He has tested it, I think, once with a calculation because there's a calculative aspect of this model. The model is actually profit driven and also value addition. So where you have losses, you cannot apply this model as a company. So the profit is very important as a return on investment for that company. So we have the key elements, and it culminates in a formula that says the net operating profit after tax minus capital employed times your weighted average cost of capital. So the key element is the net profit after tax, and that is the profit a company generates after accounting for taxes and operational expenses. So you're looking at your net profit after you've accounted for all other expenses, internal, external, organic, inorganic, depreciation, amortization. Every expense has been deducted and you have your net profit. That is one of the key elements to use in calculating this model, and it's net operating profit after tax. And we have the capital, the total funds invested in the business. And we have the weighted average cost of capital, which is the average rate of return that the company needs to pay its capital providers. That is equity holders, debt holders. So what is that average return that we need to pay them? And that is why you can see on the slide that is net operating profit after tax minus capital employed, then we multiply it by our weighted cost of capital. The purpose is to determine whether a company is creating significant value, and that's the essence of this model, for shareholders, and any more than the cost of capital injected into the business. So a positive economic value added shows creation of value, while a negative one indicates erosion of value or destruction of value. So when you keep accumulating losses, you don't have profit at the end of the day, you are eroding the value provided by the shareholders. And what are the strengths of this model? It aligns with business decisions for shareholders' funds, focuses on profit generation and efficient use of capital. Businesses are not there for Father Christmas. They are there to make profit, add value also to themselves. It encourages efficient management of resources and also capital. That doesn't downplay the weaknesses of the model, though. It's complex to calculate. Look at the.
It is.
Yeah.
Because I was trying to even wrap my head around it.
Exactly. It's complex to calculate and requires detailed financial data. So there are some financial data, if you don't, that are not provided, you may not be able to calculate it. And it's sensitive to weighted average cost of capital estimation. It may not fully capture intangible assets actually for future potential growth. So the weighted average cost of capital is a challenge, but then it's provided in the question, especially under conditions. So you need to adjust in calculating your net operating profit after tax. You need to adjust accounting profit for interest cost after tax relief. Then you have depreciation using your economic depreciation and the percentage, and you have non-cash expenses like amortization and also investments in intangibles. You add it back. So in calculating it, you charge for capital based on the value of the company's assets and the cost of capital as a percentage. So we always have that hurdle rate or that cost of capital rate as a percentage that we return to the providers of capital. So it will be provided in the question. Then the capital employed looks at the economic values, current and non-current assets, which we employed into the business, starting with the book value of the net assets. Then you adjust for intangibles, provisions, and off-balance sheet financing. So the weighted average cost of capital, like we spoke to, is the debt cost, the percentage cost of debt for interest and the principal. And that is provided in the capital structure. So you know whether the assets are equity or debt driven, and you do the recalculation annually. So there's an illustration in the case study text. Case study text is just one illustration, and if you practice that illustration, it will help you with a holistic approach on how to calculate this. The question is ADEB Nigeria Limited is on economic value added. So if you look at the case study text, it's just one question. It's not long, it's short. If you practice with it, it will help you look at how to practically solve a question like that under exam conditions. So I suggest you go back to the study text and practice it at least once. We don't have time, we'll have done that on the call, but then it's easy. And it's good to know also that the examiner has tested this model once. Yeah. One of his past questions, yes.
So there's possibility.
Yes, exactly. There's possibility that you will return it or test it again. So please look at ADEB. Look at that ADEB Nigeria. Okay. It's a very simple question. It's very simple. It's not hard. It's very simple. So just look at it and give it a shot. You'll just see how the calculations run around just the same formula. Net profit after tax minus capital employed times weighted average. So the capital employed and your weighted average, yes, you use your board mass to match them together. Then you remove your net profit after tax from it. It's a relatively simple calculation if all the components or values are incorporated in that question. It's relatively easy. It's not a complex calculation like that because the weighted average cost of capital will be provided, so you don't need to calculate for it. So just try run around that added question, and I believe you comprehensively understand what this is about. Okay, so that will be it for our 5. We've looked at 5 performance management
Models.
yes, models. Yeah. So that will be all